Welcome back to Financial Freedom FX. In this video, we're going to break down one of the most powerful trading setups using price action, a strategy that clearly defines your entry, stop loss, and take profit with perfect risk to reward. Whether you're a beginner or a pro, this setup can help you understand how institutional players trap traders and how you can profit by trading against the crowd. So stay with me till the end because this one chart explains a complete A to Z trade execution. So let's start with the foundation, the setup formation. If you look closely at the highlighted zone marked as setup formation, you'll notice a consolidation box forming after a strong move down. This box is where the market goes into range-bound movement, indicating indecision or liquidity build-up. This is a classic accumulation or redistribution phase depending on the context. Why does this matter? Because smart money is collecting orders in this zone. Price is trapping breakout traders on both sides, creating equal highs and lows. This is where you should pay attention, not trade impulsively. Now, the entry point is crucial. Look at where the arrow points. Price fakes out above the range, triggering breakout buyers. But instead of continuing up, it immediately reverses and closes back inside the range. This is called a false breakout or a liquidity grab. Here's the psychology. Retail traders think price is going bullish. Institutions know this. They push the price up, trigger stop losses, then reverse the direction for a bigger move. The perfect entry is after the candle closes back inside the range, confirming the fake out. This is how smart traders catch the real move, not the noise. Now let's talk about risk management, the stop loss level. It's marked clearly above the high of the false breakout. Why? Because if price comes back above that level, it invalidates the setup. The manipulation theory fails. So we place the stop just above the liquidity grab wick. This gives the trade room to breathe while keeping risk minimal. Remember, good trades aren't just about entries, they're about controlled losses. Always protect your capital first. Now comes the fun part, profit taking. The green area in the image shows a strong down move right after the entry. That move continues until it reaches the take profit level, which is placed at a key support level or price imbalance zone. This is where previous buyers stepped in, so price may react here again. This gives us a clear and logical target. It's not just random. Notice how this setup offers a high risk to reward ratio. You're risking a little for a much larger reward. This is exactly what makes this trade highly profitable over the long run. So let's summarize what this chart is teaching us. Identify a range or consolidation zone. Wait for a fake out, a move that breaks the range and reverses quickly. Enter on the candle that closes back inside the range. Place your stop loss just above the fake out wick. Set your take profit at the next clean price zone or imbalance. This is called a liquidity trap strategy, and it's used by institutional traders to trap emotional retail participants. And when you master it, you stop being the hunted and start trading like the hunter. Here's a bonus tip. Always confirm the fake out with volume or candle strength. Weak momentum on the breakout means it's likely a trap. And don't forget, the higher the time frame, the more reliable the setup. Use this on 15-minute or higher charts for better results. Also try combining this with multi-time frame analysis or indicators like VWAP or OBV for even stronger confluence. We're diving deep into one of the most powerful smart money concepts in trading, the relationship between liquidity, change of character, mitigation, and order blocks. This single chart reveals exactly how institutions trap retail traders and how you can flip the game by trading like a pro. So stay locked in because this is a pure gold strategy. Let's start from the left side of the chart, the area marked liquidity. In simple words, liquidity is where traders place their stop losses, typically above recent highs or below recent lows. The market knows this, so what does smart money do? It pushes price upward just enough to grab that liquidity, triggering retail stop losses, before immediately reversing. This move is not a real breakout. It's a liquidity grab, designed to trap breakout traders and stop out early sellers. This is the institutional game, and this is where you start thinking like the pros. After liquidity is taken, price quickly reverses and breaks a key market structure low, as shown by the label Break of Structure or BOS. This is a major signal. It means bearish control has taken over, and it confirms that the prior bullish move was a manipulation, not a true trend. This is your first confirmation that the market is transitioning. And now we shift our bias from bullish to bearish, because structure has officially broken. This is the moment where smart traders begin preparing for a short setup. In that P's change of character, the moment is when you help might joint 2% for smart. Next, observe the CHoCH or change of character in the chart. Done day. This is where price not only breaks structure, but also starts forming lower highs and lower lows, showing a complete character shift from bullish to bearish. This is different from a normal pullback. The CHoCH tells us the market is no longer in the same trend. It's now shifting momentum entirely. This is a psychological transition where institutional traders are preparing to sell heavily, and this moment is gold for smart money traders. Now focus on the orange zone, labeled Bearish Order Block. This is the last bullish candle before the bearish move that broke structure. Institutions use this candle to fill large orders. That's why price often returns to this area to mitigate or retest unfilled orders. And that's exactly what happens here. Price pulls back into the order block and shows rejection. This is your entry signal. You're not entering on emotion. You're entering at the institutional price zone with logic and confirmation. Let's talk trade execution. Entry, as price taps the order block and shows a rejection candle, ideally a wick or bearish engulfing. Stop loss, just above the order block zone or above the liquidity high. Take profit at the previous low or next demand zone, depending on your risk-reward preference. This setup gives you a tight stop and a high reward, exactly what smart traders look for too. The best part? This whole setup is repeatable. You'll see it over and over again on all time frames. Now, why does this strategy work? Because you're not trading against randomness. You're trading with market logic, understanding how big players hunt liquidity, shift market structure, and execute massive orders. Retail traders get trapped in fake breakouts. You, on the other hand, use the liquidity trap as a trigger, the boss as confirmation, and the order block as your entry. This is a complete smart money model from trap to trend. So if you want to trade like the pros, stop following indicators blindly and start mastering price action with smart money concepts. Subscribe now to Financial Freedom FX for more content like this, and drop a click in the comments if this strategy helped you see the market more clearly. And remember, don't chase price. Let price come to you with logic, precision, and patience. I'll see you in the next video.